Bank lobby secrets that could change how you borrow. What if I told you there's a hidden logic that banks use to set your loan's interest rate, and it's something they'd rather you didn't know? It's the reason you might pay thousands more or thousands less than the person standing right next to you. Today, we're exploring the secrets that could change how you borrow forever. By the end of this, you'll get why some people get much better deals and, more importantly, how you can be one of them. Have you ever applied for a loan and just felt completely out of control? You fill out a mountain of paperwork, hand over your most sensitive financial data, and then you wait. You wait for some mysterious committee to decide your fate. They come back with a number, an interest rate, a monthly payment, and you're left wondering, is this fair? Could I have gotten a better deal? The answer is almost always yes. The issue is that the entire system often feels intentionally confusing. It makes you feel like the terms are set in stone, that the rate they offer is the only one you can get. That feeling of powerlessness isn't a bug. It's a feature. It's how banks can maximize their profits, sometimes at your expense. It can lead to you paying thousands, or even tens of thousands, more over the life of a loan. It's the difference between financial freedom and being tied to debt for years longer than you need to be. But what if you could walk into that negotiation not as a hopeful applicant, but as an informed insider? That's our goal today. Stick with me, because we're about to unpack 4 of the biggest secrets that will shift the power back to you. By the end of this, you'll know how to get better offers and keep more money in your pocket. First secret, the secret pricing logic they don't advertise. All right, let's get straight to it. How does a bank actually decide on the interest rate they offer you? It's not random. There's a fundamental recipe they've used for years, often called a cost-plus pricing model. Think of it as having 4 main ingredients. First, their cost of funds. This is what it costs the bank to get the money they plan to lend you. This could come from customer deposits or from borrowing from other banks. Let's say, just for this example, their cost is 5%. First, their cost of funds. This is what it costs the bank to get the money they plan to lend you. Second, operating costs. This covers everything from the loan officer's salary to the lights in the branch office and the cost of actually processing your application. We'll add 2% for this. Second, operating costs. We'll add 2% for this. The third ingredient is all about you, This is the bank's educated guess on how likely you are to default. It's heavily based on your credit score, income stability, and debt-to-income ratio. If they see you as a sure thing, this premium is low. If you look risky, it shoots up. For our example, let's add a 2% risk premium for a pretty safe borrower. And the final ingredient is what it's all about for them, After all their costs and risks are covered, the bank adds a slice on top for its shareholders. Let's say it's 1%. After all their costs and risks are covered, the bank adds a slice on top for its shareholders. Add it all up, 5% cost of funds plus 2% operating costs, plus 2% risk premium plus 1% profit margin. The interest rate they offer you is 10%. Now things have gotten more complex. In 2025, many banks use sophisticated dynamic pricing models that use AI and machine learning to adjust rates in real time based on market data. But this cost-plus formula is still the foundational logic. Understanding it is the first step to a better deal, because it shows you what's negotiable. You can't change their operating costs, but you have a ton of influence over that risk premium. This also explains why different loans have such different rates. A mortgage is backed by a house, collateral the bank can seize if you default. That lowers their risk, so the premium is tiny. A credit card, on the other hand, is unsecured. There's nothing for them to take if you stop paying, so that risk premium is way, way higher. Understanding the ingredients gives you leverage. Reduce perceived risk, and you reduce the rate. Up next, how your profile becomes a bargaining chip, not a final verdict. Stick around. This is where you learn exactly how to negotiate. Second secret, your profile is a bargaining chip, not a final verdict. This brings us to the most empowering secret of all. Your financial profile isn't a final judgment. It's the start of a negotiation. Banks might make you feel like your credit score is everything, that it gets plugged into a machine that spits out a non-negotiable rate. That's just not the whole story. The smartest borrowers treat their loan application like a business proposal, not a request for a favor. You have to be the one to tell your financial story. Don't just hand over a stack of documents. Explain that dip in your credit score from 2 years ago. Point out your steady income growth. If you're getting a business loan, show them signed contracts you already have. Your job is to prove you're a better risk than the raw numbers might suggest. And here's the actionable part. Nearly every part of a loan offer is on the table. Start with the fees. Many loans come with an origination fee, which is just a charge for processing the loan. For most standard mortgages and personal loans, this is typically between 0.5% and 2% of the loan amount. For riskier loans, it can be higher, but you should always ask if it can be reduced or waived completely. Then, you can negotiate the rate itself. The best way to do this? Shop around. Get offers from a few different lenders. Once you have competing offers, you can go back to your preferred bank and politely show them what their competitor is offering. It's amazing how often they can suddenly find a way to match or beat it when they're about to lose your business. Remember, banks want to lend money to reliable people. That's their business model. By presenting yourself as a responsible, low-risk borrower who has other options, you become a customer they'll fight to keep. Coming up, we're going to talk about how your personal relationship with a bank can unlock deals you'd never see online, and the subtle biases that might be costing you money without you even realizing it. If you're getting value out of this, do me a quick favor and hit that subscribe button. My whole goal is to make finance less confusing and give you the tools to build a better future. Your support makes that possible. Now, on to secret number 3. Secret number 3 is coming up next. Third secret. The relationship discount is very real. Secret number 3 might sound a little old school, but in an age of algorithms, it might be more important than ever. The power of a personal relationship with your bank. And I don't mean sending your bank manager a holiday card, I mean showing your value to the bank as an institution. Think like they do. A customer with one loan is a small-time transaction, but a customer with a mortgage, a checking account, a credit card, and an investment account, that's a highly valuable client. When you have multiple products with a single bank, 2 things happen. First, they have a much clearer and more complete picture of your financial life, which can lower their perceived risk. Second, you become a much more profitable customer, which gives them a real incentive to keep you happy. That can translate directly into better loan rates, waived fees, and more flexible terms. So, how do you actually build this? Start by talking to the bank you're in a desperate spot. Don't let your first real conversation be when you're asking for a huge loan from a position of weakness. If you know you'll be in the market for a house in a year, start the conversation now. Introduce yourself to a loan officer or branch manager. Ask them what an ideal loan candidate looks like for them. It shows you're professional and thinking ahead. When it's time to negotiate, this relationship is another tool in your belt. You can directly mention your loyalty and the amount of business you do with them as a reason you deserve their very best offer. In a world of automated decisions, being a familiar, valued human can be your single biggest advantage. Next, we'll cover a harder topic: subtle biases that might be costing you money, often without anyone saying a word. Stay with me. This is important. Fourth secret: the invisible walls, subtle biases that can cost you. This last secret is a tough one, but it's critical to understand. Banks are legally forbidden from discriminating against borrowers. Practices like redlining, refusing to lend in entire neighborhoods based on their demographics, are illegal. But that doesn't mean bias. Both conscious and unconscious is gone. It's just gotten sneakier. It can show up in 2 main ways. And disparate treatment is when a lender intentionally treats you differently based on a prohibited factor like race, religion, or age. Think of a loan officer giving one person a chance to explain a blip on their credit report, but not offering that same chance to another person from a protected class. That unequal treatment is illegal, but often hard to prove. More common and much harder to prove is: this is when a bank has a policy that seems neutral, but in practice, it disproportionately hurts a protected group. Another example is reverse redlining, where lenders specifically target minority communities with predatory high-interest loans. And this isn't ancient history. Regulatory bodies have taken action in 2025 against lenders for allegedly locating branches mainly in white areas, failing to serve diverse communities, and steering marketing away from minority neighborhoods. There have also been government actions to address debanking, where financial institutions deny services based on political or religious beliefs. So what can you do? Knowledge is your best defense. Be aware these biases exist. If you feel an offer is unfair or completely different from what you expected, question it. Ask the lender to justify their terms with concrete data. Compare the offer to publicly available average rates for someone with your profile. and know your rights under the Equal Credit Opportunity Act and the Fair Housing Act. If you think you've been discriminated against, you can and should file a complaint with the Consumer Financial Protection Bureau, CFPB. Being an informed, assertive consumer is the best way to break through these invisible walls. So let's bring it all together. You now have 4 secrets that can take you from being a passive applicant to an empowered borrower. First, you know the basic formula. You understand that banks use a cost-plus pricing logic, and your power comes from showing you're a low-risk borrower to shrink that risk premium. Second, your profile is a starting point, not a final grade. Use your story, competing offers, and your willingness to negotiate everything from fees to the rate itself to get a better deal. Third, the relationship discount is absolutely real. Consolidating your banking and building a human connection makes you a valuable client that lenders will work to keep. And fourth, you know that subtle biases can exist. Knowing your rights and being ready to question an unfair offer is your best defense to make sure you're treated fairly. The next time you apply for a loan, you're not going in blind. You understand the game, you know the playbook, and you have the strategies to make the rules work you. You have the power to save yourself thousands of dollars and build a better financial future. Thanks for watching. If you want to learn more about taking control of your finances, check out this next video on how to give your credit score a major boost in the next 60 days. I'll see you over there.